Hey, I just wanted to read a quick note that literally came in while we've been waiting here. It came in, it came in 6 hours ago. So my apology. This is from a member. It's about our webinar yesterday. We'll be covering much of the same material that we delivered to our paid folks yesterday, today. And we also saw Oscar come in today following the program, I believe with the 7 figures. He had very nice things to say. He said he rewatched yesterday's webinar. This guy is a professional CPA, so he's no dummy. So I really hope everybody enjoys what we have for you. This is from Karen. She's in Florida, does a lot of real estate. Just a quick note to advise, I found an hour of alone time at 5 a.m. this morning to review the beginning of the member video. She was on live yesterday too. I really appreciate your thoughts on projections. That's very much along with what I've been trying to figure out. When I get a chance, I'm going to copy those couple of slides with your date projections so I can plan accordingly, having lived 60 years already through enough crazy economic times. I was trying to recall all the nuances that put us into those predicaments. With your analysis, you've nailed those dates. It's critical at the back end of life that I don't lose what I've been able to retain, so thanks, keep up the good work. Karen's very vocal. We appreciate everything she does for us in terms of coming on and sharing her experience with the program. So I'm going to start off with a presentation that's designed to be 2 hours. It's part of our bootcamp product. I'm not going to go through the whole thing today. I'm going to pick out the most important parts. We're going to look at some examples of trade alerts so you can see exactly how you get in and out of them. I can tell Donald for sure and Lewis can follow the trades very easily. They are very well versed in options. For the others, I'm not sure if you're versed in options yet or not, but we'll show you just how easy our program is. And we never ever sell puts like Donald's doing. Talk about why not. And so this is really designed to be the safe income system. So let's get started. All right, so we briefly went over this. This is our monthly return over the last 11 months. And it was quite a challenge. We started this program out with no track record. And what I wanted to show is that I can prove to people during their free trial that our product works and generate profits. We didn't go back and brag about past track records with more risky strategies. We wanted the product to speak for itself and to sell itself without big old sales letters. After being in the business for 10 years, I've seen most of these products out there and all of their schemes, tricks, and just general risk taking. And so they go sell these risky products that promise huge returns. And they typically lose investors a lot of money. And so if I had gone back in time and shown this product to myself 5-10 years ago, I probably would have rolled around and laughed that anybody would want to make 1% a month. But little did I know after doing this for a decade that most of the people buying these programs are in retirement or about to enter into retirement, and that they really need to create a safe stream of income that will last them for the rest of their life. So once I finally got that through my thick head, we designed a product that is very similar to Ray Dalio and Stanley Druckenmiller's current portfolios, which they've used for decades to beat the markets in terms of less volatility while generating consistent returns. So you'll see during times of volatility in the equity market, people tend to really like our product because we usually don't lose and generate a return, sometimes larger than our normal return. In December, we had a 1% return when the SPY dropped almost 20%. In January, who knew that the plunge protection team would rescue markets? For all we knew, this was the next big financial crisis. Fed was going to tighten policy on autopilot. There's no reason to think the market would rally 14% in January, but it sure did. Our strategy didn't break down. We made 2.2%. 1.7 in February, 2.7 in March. April, we made 1.2. May, who knows what the cause of that sell-off was, maybe just straight up profit taking, but May, the market was down 7%. We still made 2.2. June, we had 3.2. July is our only loss on the track record, and I wouldn't take it back. This was a period of intense trade talks that could have easily broken down. We positioned for the stock market to potentially pull back. We were wrong. Market flew up. Trade deal was great. Farm deal, same thing they've been talking about for years. And then a month later, surprise. Trump said we're going to do new tariffs December 15th. To be completely honest, I was completely caught off guard, but our TLT position paid off. We made 1.8%. September was slow, 0.3%. And so far, August has been pretty slow too, but you can see during this period, the stock market has gone nowhere. So how does our strategy work? Well, we're trying to get the big picture right on two core markets. Number one is the US stock market, which is very correlated to emerging markets, which is a little bonus in our Tuesday trade. And the next market we're trying to predict is the bond market. And really, we're trying to predict the change in interest rates. Now, luckily, that market is somewhat easy to predict because the Federal Reserve will go on stage for weeks before they make announcements and tell us primarily what they're going to do. So the number one thing we want to know is the Federal Reserve buying or selling treasuries? Right now, they're buying. And this is after a year of selling in 2018. Now, we all know what happened in 2018. First, emerging markets crashed. Then the US stock market crashed, and bonds were crashing during that period too because they were hiking up interest rates and selling treasuries. Now they're doing the opposite. In fact, they've bought $200 billion in treasuries, which is freeing up capital on all these banks' balance sheets as we speak. The number two thing I'm carefully monitoring is whether the Fed is raising or lowering interest rates. And as you'll see, every time they raise rates substantially, we get a stock market crash, like clockwork. Right now, they're lowering interest rates, not just in the US, but globally. And this is because of a global slowdown where the global GDP has crashed from 3.8 to 3 in the last year. And then the third thing we need to track is the consumer price index, otherwise known as inflation. And what you're going to learn is really the breakdown in our strategy only occurs when there's inflation, runaway inflation. And we'll take a better look at that in a few slides. So right now we're in a market environment that's low rates, low inflation, and we already have QE. If you listen to Ray Dalio, he thinks we're in the 7th inning. We're at near the end of the rope of this current bubble. Now, it's not just a stock bubble, it's also a bond bubble. $288 trillion in sovereign debt around the world, $16 trillion in negative yielding treasury bonds. Those are products that are guaranteed to lose year after year. So this is the current recommendation we have that I suspect will work for potentially the next 2 years. Now, the big catch is that we will play the SPY in both directions based on bad trade data as the primary catalyst for a short-term sell-off in the SPY. So we're currently long the SPY, trading it Monday, Wednesday, Friday. Long emerging markets with about 1/3 the position size, trading it on Tuesdays exclusively. And we're long the TLT. Now, keep in mind, we have about an even ratio of equity in TLT versus the SPY. And this is a 50% equity portfolio, 40% bond portfolio, and 10% gold portfolio. Now, in terms of trying to be bearish on the S&P 500 for a considerable time, a few things need to develop. So I would be very skeptical of getting overly bearish on equities, even if trade talks were to escalate right now. I would think it would just be a short-term sell-off and not a long-term bear market. And we'll take a look at why. But primarily because we have rates on the descent, we have inflation at a very low level, and we have massive quantitative easing happening worldwide. Now, if you have less than $75,000 to follow the program, we have a light version of the product that accomplishes the same goals with the emerging markets. So you get rid of the SPY, and you can follow this with a lot less and have the same basic risk exposure. So this would be 400 shares of emerging markets on Tuesday, 100 shares of the TLT on Thursday. So what ends the party? Eventually, it will be rising inflation. When inflation starts to creep up, at some point, the central banks will be forced to raise rates, and the threat of stopping QE will become significant. Now, when this happens, it'll be heyday for gold and silver. So you can see we will switch out emerging markets for silver, and we'll still be long our gold position, as well as equities. And in this environment, the first bubble that will pop will be the bond market. The second we see significant rising inflation, watch for the bond market to sell off. Now, with our strategy, we can easily play that while still owning the TLT by using the options market. So we'll show you the clever way you can profit from a down move in either of these assets by owning it and doing what we call an inverted option collar. I'm expecting by 2021 to 2022 that we will finally have inflation causing problems and forcing the central banks to stop the quantitative easing and start raising interest rates. Right now, none of them want to do it. Nobody wants to work down the debt. No one wants to have the pain of resetting all these bubbles, of getting rid of all the misallocation of capital. The next phase, which I expect could be from 2022 to 2027, this is Jeffrey Gundlach. He's the bond king. He took over the role. One of my favorite analysts to look at. This would be during a period of rising interest rates. We're facing inflation. The Fed has to raise interest rates. They cannot sidestep it any longer. And the threat of QE ending or going into quantitative tightening will now start to occur. This is the time period where we finally would want to do what you're asking, Lewis, and have some inverse bearish ETFs. The product I like is SQQQ. So we'll not only be shorting the S&P 500 with our bread and butter trade with the inverted option collar, we'll also have a smaller position in SQQQ, and it'll be time to buy the TLT because rates will be elevated and set for a period of dropping, and interest rates will be so high it'll finally make sense to own the dollar in a bank account again. We'll look at some times in history where the interest rate was actually at 20% in your lifetime. And then you get your Warren Buffett strategy. This will be after a massive reset. The bond market popped, the stock market popped. Everything's at a discount, rates are very high. And we have a great reset. This is where we might actually get out of the SPY and take advantage of the QQQ. Now these share ratios are all based on current prices. At this point in time, I'm expecting a crash in the equity and bond market. And so we'd be long QQQ instead of the SPY, long emerging markets. And instead of the TLT, we look at LQD. That's the investment grade ETF bond fund. And at that point, I'd also look at the largest position in Buffett's portfolio, currently Apple, and we'd add in a little extra exposure at that period. So that's what I see happening in the next decade. Right now, this is our setup, knowing we're at the final end of a big market bubble. Is this setup right here. So it has the safest assets that provide the most protection. And again, that's the S&P 500, the SPY. We're taking advantage of option expirations 3 times a week. And we're owning the long end of the treasury curve. So it has the most volatility in rates and can provide the most protection on our long SPY position. So even though we do suspect there are some bubbles to pop, we're in the final stretch. We still have low rates. We still have low inflation. The Fed can still drop down towards 0. So this bubble is not at the end yet without some significant stressors. Let's take a look at the 3 types of trades we issue. This is our bullish loose option caller. So if we think the underlying asset will travel higher, but we don't want to have all the risk of just owning it outright, I'll sell an out-of-the-money call and then buy an out-of-the-money put. And so in this setup, we forego any profits if it travels too high. So in this trade, our maximum profit would be $2.90 a share, which would be about a 1% return in a 48-hour period. That doesn't happen very often. So most of the time, we're able to enjoy most of the profits of the asset with this trade setup, but not have the complete exposure to downside risk. So we're using that out-of-the-money call option that we're selling to finance downside protection. So just in case that Trump tweet comes out and freaks out the market, well, after we get to 295, our maximum risk ends because we own the put. So in this setup, we have a pretty even risk to reward ratio. That's the setup we are currently in right now on the SPY and the TLT. Now, when prices get elevated, for example, on the SPY, until we start seeing some positive momentum on the trade talks, which happened November 15th in Chile between Presidents Xi and Trump, if we bounce in the 302 to 305 range, I would prefer what I call a tight option caller. So this is where we sell an at-the-money covered call. So we still generate profit to the upside. But if the market trades slightly down, you can see we still make a small profit. And if the market were to pull back significantly, we have very limited downside risk. So in this trade, potential return over 48-hour window is only 0.3% in both directions. So this is how we can make a nice profit even in a sideways market. And finally, we have the bearish inverted options caller. You try to short the SPY or the TLT by buying put options, good luck. Market goes up a couple dollars against you, you've lost 50% or more of your put. If it doesn't crash within half of the time premium you've purchased, you're going to lose another 50%. Most of the time, buying put options is a disaster. With this setup, we can actually own the asset and relatively safely profit from a long-term down move in an underlying asset. So in this example, we are selling an in-the-money call. So in this example, the SPY was at 298. I'd be selling a 297 call for a very large credit of 219, and then buying an in-the-money put for 227. So I'm long the put, but I'm financing it once again by selling the call option. This setup is highly profitable, but the entire financial system is not engineered for either the bond market or the stock market to go down for very long. It ruins everything. So we'll see. There's only a few times in history where they will let the financial system break so they can have a big reset. And there's something that will come that forces them to do this. We'll take a look at that in a minute. So this setup, you can see we have a maximum risk of $100, but a potential profit of 195. So a 2-to-1 ratio. So we love to put on this trade. It's just very rare when we want to do it. So again, if we sell an out of the money call, buy an out of the money put, we have the biggest risk to reward ratio. This is our most common trade setup right now. When prices get elevated, like we're probably going to see on the S&P 500 in the next few weeks, and we believe there's a catalyst, but it's too far out, we don't want to be completely out of the market. We think it's going to travel sideways. Here's our ideal trade setup. So it does generate a profit if the market just goes down a little, but if it trades flat or up, it hits its maximum profit. And then once again, the inverted option caller, we sell the in-the-money call, buy the in-the-money put, and we can actually generate a safe return betting down on an asset by being very clever. You're using your 100 shares of whichever ETF it is to finance your down bet. So even if the market goes up, with this strategy, we risk $100, and that would be 0.3% over a 48-hour period, with potential to gain 0.6%. So we'd love to do this trade. I'm just telling you, it's very rare. The whole financial system is engineered for this trade to not work 99% of the time. This is a look at the S&P 500 against the TLT ETF. Up top is the SPY, down below is the TLT. And all I want you to gain from this picture is to note that when the S&P 500 turns red, selling off significantly, the orange line shoots up. Now, during this period of about 2 decades, both the TLT and the SPY have gone up in value. Sure, the S&P 500 is up significantly more, but it's had significantly more volatility. When we overlap these two assets, it makes it a very smooth return, which is much more ideal for anyone who wants to generate income with low volatility. Here's another chart of just the TLT. And you can see in general, it's been traveling higher, but every time we have this market scare, it goes up significantly. So look at 08, 2011, 2015, the China scare. Most recently, the December Christmas massacre. These are the big jumps in the TLT that allow you to protect your assets with very little risk. Here's another example. 2009, you can see the S&P 500 crashed 50%, but the TLT went up 40%. So think about it. Your put options are catching profit, limiting the downside on the SPY, while your TLT is going up in value. So that's how we can generate profits in downturns with this very simple setup. Another example, 2010, 2011, 2012, one goes down, the other goes up, and vice versa. In general, they both returned a profit, 26% over this period for the TLT and 42% for stocks. 2013 to 2015, stock market provided a 51% return, but the TLT still delivered about a flat return. So it provided that insurance without taking away a lot of profit. 2016, 17, and 18, same setup. SPY went up 33%. TLT provided some protection in 2015 and 16 when the market was volatile. But when the stocks flew up, TLT didn't harm our returns. Okay, and then most recently we had that tremendous sell-off from October through December, and the TLT went up considerably. Went from down 6% to up 20% on the TLT. Stocks provided some uncertainty, some drawdown, and then popped back up. Both went up together. Now, another part of our portfolio is playing the gold market. And so there's basically just one part in time where you want to be long gold, and that's when rates are going lower, central banks are printing money, quantitative easing, and then you need a little uncertainty. Now, the good news is central banks only print money and lower interest rates when there's some serious problems in the economy. And right now, it's China's slowdown is crashing from 14% a few years ago to 6% this quarter. They have a massive slowdown. They've been the growth engine. With any additional pressure, expects the gold market to fly higher the next time we have a scare. So we're in that environment to be long gold right now. But in general, we don't want to be, because you can see the volatility of this asset. Another part about gold against the TLT is you can see it's not exactly correlated. So by adding this to our portfolio, it adds another layer of diversification that helps normalize our returns. Now, with spot price near 1500, we rotated out of GLD, spot gold, which we've been playing all year for considerable return. Now we're in the gold miners. So gold miners can generate much bigger profits as long as that spot price remains high. So that's our current play right now, is GDX. Now, if you're going to make the big plunge and liquidate a bunch of random stocks in your portfolio, it's important you know what you're investing in. So let's take a look at what's under the hood of the SPY. Its assets have grown massively in the last year. I think it's added $100 billion in assets under management in just the last 12 months. It's by far the biggest hedge fund in the world, or rather fund, with Ray Dalio's Bridgewater only having $122 billion. Last year, it was only $40 billion bigger than Ray Dalio's. Now it is over twice. It's by far the most traded security in the world, and it's the only security with 3 options a week. So if you're looking for diversification and safety, you can't beat the SPY. Here's the sector breakdown: heavy in tech, financials, health. Here's your biggest positions. Now I'm going to tell you, if your biggest equity position is not one of these 10 companies, you're probably making a severe mistake near the end of a market bubble. These are the safest companies to own because they print the most money in terms of profits, but more importantly, they have the lowest cost to borrow through the bond market to do, guess what? Stock buybacks. These guys buy their stock back at a faster pace than any other companies in the world. And they can do it at the lowest cost in the world. In fact, Microsoft has some negative yielding bonds in foreign markets. So they're actually getting paid to borrow money and buy their own stock back. And just to get a feel for the size of these companies, 39 billion, 55 billion, 12 billion, 34 billion. This is their net income of some of the companies on that list. And as we go down the S&P 500, which is 504 companies, you can get a feel for just how many companies are in there that you know of, like Visa, Exxon, AT&T. These guys only have a 1% total position size. So you just got to ask yourself, am I overweight in a specific company that's putting me at business risk? Walmart is almost just 0.5% in the S&P 500. Finally, emerging markets is an important part of the portfolio. Ray Dalio, Stanley Druckenmiller, Jeffrey Gundlach, the big banks, they're all betting big on emerging markets. These companies sell to 4 billion people in Asia, and your big big position is going to primarily be Alibaba and Tencent. These are two companies, unfortunately, based in China, that have quickly become monsters. They're in the top 10 most profitable companies in the world. And this ETF actually has 1,000 different securities. Now we have a 3-to-1 ratio, and we'll be more than happy to short emerging markets if the trade deals talks break down. But for now, this ETF has an easy 20% run up just to get to 2017 highs if we get a positive catalyst with the phase 1 trade deal November 15th. And you can get a feel for the size of these companies, billions and billions of dollars. If you only own American companies, if you only own the SPY, you're missing out on about 2/3 of the population in terms of the companies providing those products. And this just shows you the scope of these different index products that will do a far better job of diversifying your portfolio and reducing your risk. With just 2 ETFs, you have 1,500 companies in your portfolio. I'm going to skip through a little bit of this. If you follow my commentary, I'm obviously pro-America and hope that we will get a significant trade deal with China. But this part of the slides just shows a lot of the facts, why we can't be oblivious to what's happening in emerging markets. And again, our goal is to generate profits with our portfolio. So I'll skip through that. Here's a quick look at GDX. These are the companies that make the most sense in the gold mining industry. If you have a large position and it's not on the screen right now, you're taking a huge amount of risk. Most of these mining companies have been operating at losses. It's only this recent run-up in spot gold price that they can create a profit. And these are the only companies who have access to capital so they can start mining. The rest are just going to be doing penny stock campaigns to pump and dump their stock. And in fact, one of the guys I like to listen to on YouTube, this guy's a character, but he's out there pitching Sandstorm Gold as the holy Bible for gold miners. And look at GDX, it's only 0.5%. All the big boys are playing these two companies almost exclusively, Newmont and Barrick Gold. So by using ETFs, we can give your portfolio much better diversification, and we can normalize your results. But when does this strategy break down? Well, there's a few main things that can break down our strategy. Now, of course, we've shown you the slides as to how we react to that, when we think it's going to happen. But essentially, it's rising rates. When they rise the interest rates of the Federal Reserve, it causes the bond market to crash first. Then once those yields get too attractive, stock investors jump ship. Why risk a volatile equity market when a treasury will pay you 3%, 4%, 5%? Now, what causes the Fed to actually rise rates? Well, there's really only one thing, and they do everything in their power to try to avoid this, but it's inflation. So this is the most important period of time that you guys need to be worried about going into retirement. It's 1965 through 1980. It's a 15-year bear market. And it was caused by runaway inflation that Paul Volcker had a hell of a time getting out of the system. And we'll take a look at his policy during that period. But if you think that you can just buy and hold and live through a 1-year crash like we had in 2008, or an 18-month crash like we had in the dot-com bubble, well, I got bad news for you. Ray Dalio is predicting that those were just mini waves in the business cycle. But we're entering a period that'll be more similar to 1929 or 1965, where inflation forces the Federal Reserve to keep rates high and for governments to finally get control of their deficits, and work down debt levels. And until this reset comes, you're playing with fire to just be long stocks. So what exactly is inflation? The CPI index. Currently, they're printing a 1.7 inflation rate, which is very low. But what's worrying to investors is that they manipulate this reading every year to keep it artificially low. Because we all know inflation is certainly not 1.7%. Give me a break. Think about housing. Think about medical costs. Think about college tuition. Here's a look at inflation over the last 3 decades. And this is also against the rates of the Federal Reserve. And so we can see the most recent high was 2.7. And most likely we're headed towards 0 because of the global economy slowing down at such a rapid pace. The central banks are racing to drop interest rates and start printing money to try to save the economy and keep this business cycle going. But you can see this works until inflation starts to creep in. And when inflation has peaked up, we've had the Great Recession, that's the 08 crash. We had the 80s. And here's a look at the CPI against the federal funds rate. So every time that blue line starts to peak up, that's the inflation rate, you can see the central bank has a very clear strategy. They push that red line dramatically above the inflation rate, and inflation comes right down. But what else happens? Well, the few times in history we've had negative GDP prints are right after they jack up rates. Makes sense. So first you get the pullback in your bond market, and then you get the pullback in the stock market. So that's when our strategy has to be adjusted, is when we start to see the central banks talk about inflation's getting hot and they're going to start increasing rates. Now, the good news is they tell you when they're going to do it because they're trying to not create market chaos. Another thing is we can see the Treasury is like a magnet to that federal funds rate. And so because we know their plan is to lower interest rates, because we can look across at other central banks, that they're all dropping rates. 80% of all central banks have dropped rates this year. We can predict the path of the TLT pretty reasonably at this point in time, because we know they have some room. They're at 1.75. The lowest they'll go is most likely 0. And so clearly there is much more inflation than they like to tell us. We can look at medical care going up 100% since 2000. Pretty much everything the government's had their hands on and subsidized or guaranteed to the banks, the businesses have gone in and taken advantage of that fact and dramatically increased costs. And so if we do look at the measurement for inflation in 1990, we're sitting at almost 6% inflation. With that metric, the Fed should already have rates not at 1.75, but probably up at 6. If we look at the metric they used in 1980, the picture's even worse. Not only do we have nearly 10% inflation, it's in an obvious uptrend. So we look at the economy, it's firing on all cylinders, unemployment rate's very low. This is going to cause corporations to fight over employees, increase wages, and put more and more pressure on inflation. All right, let me look at a few slides I want to point out. So Ray Dalio likes to compare this time period to 1929, right before the Great Depression. World War I was over. The world was trying to get reparations out of Germany that they could not afford. And it ended up putting the whole world in a tailspin. Now, arguably, you could say we're doing the same to China. It's not exactly the same, but their economy is clearly collapsing. Their GDP growth is going from 14% to 6%. They're doing this with top secret of financials because it's top secret part of their communist system. So we don't even know how bad it really is. I like to look at the Cold War as another similar analogy. Lots of government spending, huge debt to GDP ratios. Markets didn't mind. They really didn't mind. We had a great stock market from 1947 to 1965. Okay, but look at the inflation rate. Inflation was under control until 1965. Look at 1966. It pops up to 3, 2.8, 4.3, 5.5. Well, what happened? Well, look, stock market went from 2,000 to 8,000 for a 25, or rather a 15-year bull market. And so I would suspect we're somewhere along the lines of 1962 or 1963. We're in the final inning. We're going to blow this bubble up as big as we can until inflation pops it. Now, if Ray Dalio is correct, we're not going to have a nice one-year recovery like we did in 08. We're going to have a 50-year cycle, so a 5 to 10-year recovery. And think about it, the entire world's in a bond bubble, $288 trillion of debt, 16 trillion negative yielding. Things are not right. The banks are getting $120 billion of loans overnight. They're about to print more money than they did in the 08 crash, and we're at all-time highs. Things are supposed to be great. So certainly there's reason to be alarmed. There's reason to play it safe. And there's reason to be concerned that you could have a long-term bear market in both stocks and bonds. Now, I don't think we're there yet, but this just is something everyone needs to be aware of. So how did they deal with runaway inflation during that period? Paul Volcker would jack up the rates, lower it down, inflation came back. It wasn't enough. He'd jack up the rates, pull it back down. Wasn't enough. He continued to do this till we hit a peak interest rate at the federal funds level of 20%. I don't think we're going to get that high of a rate in this day and time. You'll see as we go through the timeline, the markets have become ever more sensitive to interest rate change and inflation change as the debt bubbles get bigger and bigger. And then what happened after that? We had a period, finally they got all the malinvestment out of the market. People were starting to save, they're getting high rates of interest in their bank account. And we have Alan Greenspan enter a period of lowering rates. Inflation was under control, slowly dying down. You get the next big bull market. So you can see how these cycles line up perfectly with what we showed you guys in these slides. Let me go back to those so we can see this timeline. Right now we have low rates, low inflation, and QE. We want to be long stocks and long bonds. Most of the time this strategy works in history because the entire financial system is engineered for investors to buy and hold these products. The only thing that breaks their whole engineered system is inflation. We don't have it yet, at least by their metric. And the Fed does a decent job at warning us before they will switch gears. So we have low rates, we have low inflation, we have clear quantitative easing. It's hard to bet against the equity market. Now, if I get a Trump tweet that says we're raising tariffs, that'll probably create short-term volatility in the SPY. We'll use our inverted collar for a short-term profit while the TLT generates the profit. But I'm not ready to predict a long-term bear market until inflation starts to perk up and we get the central banks telling us we're going to have to raise rates. Now, they'll do that either in two conditions. In one condition, they'll do it because they think the economy is strong and they want to be able to have ammunition to fight a recession in the future. In another situation, they'll be doing it because there's inflation. So we'll see which one it is. If we get a trade deal, if everything gets merry, if earnings start to pick back up in some of the slow growth areas like China, Germany, that might be the case. They'll tell us they're going to raise rates because everything's gravy. On the other hand, trade deal could break down. They continue to print all this money and inflation comes and forces them to do it. There's really just not many other outcomes. Eventually, inflation will work its way because of the massive irresponsibility of central banks around the world, because of the massive irresponsibility of governments around the world. Nobody wants to pay off the debt. They want to just keep racking up the credit. It's like a teenager who's got $1,000 left on their credit card. Why stop now? They're going to max that puppy out. And that's when the pain begins. So realistically, this period of time is a year or two out, but it's not that far along. As they rise rates, eventually it'll get too high that it causes a crash, not right away. So the first play, short the bond market, stay long stocks. This will be the end of the bubble. Once that bond yield gets too attractive, money flows out of stocks, which are highly risky, into an almost guaranteed return from safer sovereign bonds. And that's when we would finally want to be significantly short the market for a prolonged period. There's going to be a 1-year correction reset. Ray Dalio doesn't think so. He thinks it will be much longer. And then you get the reverse. You have the reset, the bond market reset, the stock market reset. Now interest rates are going from a high level back down to a low level. Now your Warren Buffett strategy really pays off well. All right, let me go a little further in my presentation. So again, once again, I would say a good analogy is 1963, Cold War, lots of government subsidies, lots of deficit, huge debt to GDP ratios. You can see the bubbles coming. It seems like the market will never give up. Eventually inflation comes in, you get this bear market that lasts a considerable time, 15 years. The Fed reacts by hiking up interest rates. Then we get a period of low inflation. We had a great reset. Everything was at a bargain. You get another big bull market. But then you get misallocation of capital. You get malinvestment. You get the dot-com bubble. You get pets.com blowing out 100% of investors' money. Think of WeWork today, Peloton, Uber. So many of these tech companies are not generating profits and have insane valuations. Now look how sensitive the economy has become to changes in inflation. It's no coincidence that inflation jumped above 3% in 2000 and 2008. Shortly after, you get that huge market crash. And so here are the Federal Reserve chairs of that period. And so what I think is nice that you can tell, now our job is primarily to listen to the Federal Reserve and to listen to Trump. So if the Federal Reserve tells us they're in a period of lowering rates, that's the key thing to know. And in terms of protecting downside risk, we got to follow the trade war. So it really simplifies our job to predict the markets and create return. And you can see, once again, It's a period of hiking rates that causes downturn. Right now, they're lowering rates, printing money, and the inflation print is 1.8. So we got to be long stocks, long bonds. How low can they drop these rates? Probably to 0. So they still have, if they were to drop 25 basis points every 3 months, that gives us a 2-year timeline, 2021. And so everybody thought Jerome Powell is going to be our hero and hike up interest rates, get all the misallocation of capital out of the markets, pop all these bad bubbles. Let us have the pain today so we can clean out the books for tomorrow. Nope, he's back to what they love to do. Lower rates, print money. Just a few things to give you an idea of what we're doing for you. And also, if you were to join our boot camp, you know, some people want the trade alert given to them on a silver platter, which I love to do. But some people like to do the same thing I'm doing, so they're just as embedded into all the information as I am. So here's just a look at what I'm doing. Number one, I recommend you use Ameritrade for your trading free commissions. Their phone app is excellent. A lot of my clients will do trade alerts from their phone on the go. They're doing it at dinner, at restaurants, in the airport, on a plane, on a boat. The phone app's great. The trades take 30 seconds. We'll look at some exact trades in a minute, but this is my recommended broker. 2, we deliver our product via text message and email, but we're also going to open up Telegram app. So if you do want to download that app to get the trade alerts, another way to get it flawlessly. 3, I spend a lot of time on YouTube. So Macro Voices, Fox, CNN, I've got a bunch of different channels I follow. I try to get different perspectives. I've got a Russian channel, I've got a Chinese channel, I've got people who are not in finance, but they spend most of their life in China. We've got hedge fund interviews with Macro Voices. We've got all kinds of different perspectives to get a wide variety of ideas and perspectives all boiled down to one. But at the end of the day, we're just trying to predict changes in interest rates, changes in Fed policy, and then look out for any major problems ahead. Right now, that big problem is the slowdown in China, the huge government debt bubble, and trade tensions with US and China. So we make watch lists. This thing is nonstop. If you don't have the YouTube app, it's a great add-on. Here's some of the channels I study and follow and try to get as many different perspectives as possible. So I've got my Bears, I've got my cheerleader Bulls, I've got some of these are just actually historians. Sometimes we need to go back and study the Cold War or the Great Depression. We need to look at what happened in World War I and World War II to create some of these problems that perhaps we're repeating today. YouTube TV app, I like to follow primarily 4 channels: CNN, Fox, and CNBC, as well as Fox Business. Twitter, try to limit how many people I view. These are the key people I'm following right now. I will alter it depending on where the bigger risks are. So you can see we've got the long view. This is a guy who used to work for Ray Dalio. Great insights. We've got Live Squawk, Donald Trump, Zero Hedge, Kyle Bass, Elizabeth Warren, McConnell, Nancy Pelosi. So in my daily updates, you'll see I'm going to highlight what are the key things you need to be worried about. Who are the key people who can make the market move that we need to listen to on a daily basis? So my daily video does that for you. But if you do join our boot camp, you'll get all of these exact channels with a daily, call it the daily dump, all the information I'm studying. Another app I recommend that we're following is Bloomberg. I like to look at the currency, futures, and bond market from that app. Again, free. They also have a great free daily newsletter that summarizes a lot of the stuff we put in our daily video. Seeking Alpha, another great app we take advantage of. You can build a nice stock list. I have a slightly different set of stocks I follow, mainly trying to predict problems before they come. So looking for canary And the coal mine sort of indicators, my favorite is LQD. That's that corporate high investment grade bond fund. If that were to crack, that would signal the corporate buyback scheme is over. What's neat is they will provide you a feed of articles based on which tickers you're following. And these articles typically are specialists who really specialize in these individual ETFs or companies. When I'm not using those apps, I like to plug in my Roku. I got that on all TVs, so we have access to my YouTube playlist and YouTube TV. This is allowing me to essentially get about 12 hours of data nonstop. So it's hard for something to get by. That could be a significant risk to our portfolio. And I'm summarizing it. I'm taking all of this data, summing it up into a 30, 60-minute video each day and giving it to you in our daily update to support the trade alert. In fact, I have two phones. One is just to sit there with the CNBC, so that I can also have access to the other phone. And then I also recommend getting a Fire HD to read Zero Hedge. Now, not every article, but there are a few that come across that are important. And again, I identify these for everyone. Let's take a quick look at a few trades that we've done recently so you can see how easy it is to follow. And then we'll open up for Q&A. Now, before I jump into the real trades, let's just review the strategy once again. This is the SPY, Monday, Wednesday, Friday, 100 shares relative to 200 emerging market, 200 TLT, 250 GDX. If you had $150,000, you'd double it. If you had $300,000, you'd multiply these by 4, etc. So it's very easy for you to understand exactly what position size you should have of each asset. Now, the SPY and the TLT are not going to change anytime soon. And as you've seen, even in the future market cycles, we'd simply switch our strategy with the inverted option caller to safely profit from down moves. It's the Tuesday trade and the buy and hold trades that do change more frequently to take advantage of different market cycles. So let's take a look at some of the trades. And this will be the portfolio anybody joining today could expect us to use most likely for the next 12 to 24 months. And it's going to get exciting, folks. Think about the 2020 election. If we thought 2016 was crazy and the last 3 years of impeachment harassment, imagine how hostile it's going to get in the next 12 months. That TLT is going to pay off pretty nicely, I'm thinking, especially when we're at the verge of escalating the trade war with China. All right, let's take a look at some trades, and then we'll go to Q&A. Let's look at all right, so this was delivered on October 16th. So the way it works is about half an hour before the trade alert comes out at noon, I have the trades all ready. I have this document ready. All I need to do is take screenshots of the exact trade and then do the math for you. What I'm going to provide for you is the accounting for how to track your profit loss on each trading period. And so it looks like this. We're going to track the change in value of the underlying asset from entering the trade and exiting the trade. And again, we only touch these positions at the specific trading period. So for the SPY, it's Monday, Wednesday, Friday at noon Eastern. I'm pulling the trigger 30 minutes before you and then getting this out to you. We have a whole team of people that review the trade, tech guy who builds this into HTML and gets it delivered via email and text. This has to happen quickly. Up top, we like to entertain you with a comical cover, but what's important is you can click that video and talk to me live. So if you have any questions at all about the trade, you have me live via YouTube live stream. Now, what's really neat is YouTube records this footage, keeps it exclusive to our paid members, so no one can steal it for free. And then if you get the link later, even an hour later, the trade's still fine, and you can still watch the replay by clicking that link. So it gives you access to me live, and it allows me to record the video after the trade is out. So this is getting you the trade alerts as fresh as possible. There's nobody else that does this. So we're going to review what's the change in price of the SPY. In this case, it went up $2.40. What's the change in price of our option caller? Well, in this particular trade, we collected 60 cents and we had to pay $1.79 to exit the option caller. We lost $1.19. Net profit, $1.21 a share on 3,700 shares. That's our model portfolio. Your profit will be based on how many shares you own. Then we go into the key news. So this is a summary of what you're going to learn in the video with a lot more detail. I'm only looking at the biggest things that are really going to impact the market. I don't pay attention to all the little stuff. We're not going to waste your time with things that are not real market movers. Next, we're going to show you an update daily on our return per portfolio. Now, it is important. We recommend overlapping the entire strategy. But this lets you see how each portfolio is performing and what our breakdown in asset allocation is at any given time. It doesn't change very often. Then we give you the monthly return, and in some cases we'll also show you that particular day's breakdown. So we have this return broken down in our track record, which you have a link to every day. So you can see the return per strategy or combined, month over month. So you can see total return of all strategies, return on the SPY. Started the year out strong. Market's been having trouble going anywhere the last 6 months. Equities portfolio 2. It's a riskier portfolio, but it generates higher return. Our buy and hold portfolio in precious metals and gold. It also plays the cryptocurrency market with a tiny position. And then the big position in the bond portfolio. It took a hit in October, but it has delivered profits in 9 of the last 11 months. And we go a little lower. Here is the trade summary. This is what's sent to you via text message. A lot of our clients rely on the text message to place the trade. They know when it's going to hit. They got their phone app. They like to travel. They're trying to enjoy their retirement. They're done being full-time traders and looking at charts all day. If that's not enough to help you get the trade on, here's a visual picture which has all the prices screenshotted. So we'll show you how to get out. Typically, it's buy to close the call and sell to close the put. If the put's worth a penny, nobody wants it. Let it expire worthless. We always have to close out the short call. And then we're going to enter into the new contract. Sell to open, buy to open. It's always going to be selling a call and buying a put. Selling a call is a lot like taking candy from a baby. It's a speculative bet that poor people make. We'll take their money all day long. Now, in some cases, we'll use that to generate income if we think the market's trading flat. In some cases, if we think the market's traveling higher, just not that high, we can use it to finance free downside protection. So this can often act as a drag on our return, but it provides ultimate protection. An atomic bomb could be launched from North Korea tomorrow. S&P 500 collapses 20, 30 points. It doesn't matter. You put the money in for the insurance. It was a measly 40 cents a share, and now you get a guaranteed $2.96 per share. You wouldn't live your life without medical insurance. Why don't you have portfolio insurance? After that, we have a profit loss chart. If you look left to right, it's showing you the price of the SPY. So that's your your x-axis. Farther we go up, the higher the SPY. The farther we go left, the lower the SPY, or whatever the asset is, in this case the SPY. If we look at the y-axis, the higher we go up, we can see our profit. Our profit hits a maximum profit once we go to the strike we've sold our call. So at 301, our maximum profit is reached. And in this case, it's $213 maximum profit per contract, or 100 shares of SPY. And on the same breath, maximum risk of 287. So we know our maximum loss and maximum risk at all times during this trade. That's why we don't have to touch the position and will not touch the position outside of our trading period. That's so important. If we were to do emergency alerts to try to cover positions at unpredictable times, this product would not be followed by over 100 customers, many of which are trading million-dollar portfolios. Because we have this exact setup, it creates a passive strategy where you know for a fact you will not touch the position outside of the trading time. And then that's it. Then you wait for the next trading day. Let's take a look at another trade. This was our trade on 10/18. Net profit, we lost 6 cents. SPY went from 298.73 to 298.77 for a 4-cent move, but our option caller lost 10 cents. You got your key news, you got your updated return, your breakdown per month, you got your trade alert. This one, the put was worth more than a penny, so you can see we buy to close the call, sell to close the put, go to the next trade, sell to open, buy to open. It's very repetitive. It's very easy to follow. People get very close to the same results because of how predictable our strategy is. And some of our clients tell me they have fun trying to guess what strikes I'm going to pick. But once you understand our strategy, when you look at the big picture, when you understand we're just trying to follow the Federal Reserve and listen to what their macro view is and what they're doing with quantitative easing and interest rates, you can see our reaction time is very slow motion. And so our trades feel very repetitive and slowly adjust over time. Emerging markets. Here's our Tuesday trade on 10/22. Same setup, showing you what the emerging market ETF did, what the caller did. Sometimes we'll throw in a chart. I just wanted to show you in this chart, the 2017 high is a 20% return from here. Go over the key news, total return, breakdown of assets. Here's your text message summary. And here's your new trade. Sell to open, buy to open with a risk graph. Here's an example where we traded on 10/23, so that was just yesterday. So you get a feel for the current trade we're in right now. Summary of all the results. We actually added in this week this month-by-month return, so you can see the results. Summary of the trade. Buy to close, sell to close, sell to open, buy to open. And so that's it, folks. That is how repetitive the strategy is and how easy it is to follow and why it works so well. So at this point, I would like to open it up for questions and let everyone know who is on there that we do have an annual discount offer. If you call Dean at 505-322-7515, he can give you all our different pricing options. But at this point, I would definitely like to take a break and see who has questions and go from there. So I'm unmuting everybody. If you have questions, please feel free to talk. How about you, Donald? What did you think?
Interesting, very interesting. I'm trying to digest everything that I heard, but brought out a lot of good points, and I appreciate your time on this.
Well, excellent. Thank you for your comments. So you ready to buy the TLT or what?
Excuse me?
You ready to pick up some TLT shares and buy some puts or what?
It sounds like I probably should, doesn't it?
Yeah, most likely. What other questions come to mind, Donald? Any?
No, I tell you, I'm gonna make some notes, and I'll probably give you guys a call and talk a little bit more about it in private.
Sure, absolutely. And a lot of people ask me, well, how much does a product cost?
Well, that's a good question. What is it?
But here's what I often ask people. In fact, Lewis was on a few weeks ago. He told me he had lost 6 figures in the month of May. Now he got that back because the market recovered, but what if it hadn't? So sometimes I challenge people. I say, well, how much will this product cost you if you don't buy it? How much do you have to lose?
Well, that's true.
A lot of people who buy our product, Donald, will actually pay for it before their free trial is over. I would say the average client has made at least 10 times what they've paid our program after they follow for about 10 months. But we're dealing with a lot of people with large accounts.
Yeah.
So I think if you give Dean a call, our price is harmless compared to.
Are the majority of your customers larger accounts?
Oh yeah. Well, you're not that excited about making 1% a month unless you got some serious capital.
Right.
Yeah. We got one of my favorite clients, a guy named Murray. He's out on the Bay. He's 90. This guy is a character. He's got 1.6 million following. Made a fortune, relative to what he's paid us. He's bought everything we have from the boot camp to the lifetime membership. Calls me all the time. He always wants my input. He's a hardcore Republican living there in San Francisco, so he's a funny guy to talk to. But yeah, I'd say most of he started off about 100,000 following it. It didn't take him but 3 months to realize this is just so much smarter than what he was doing. So I think he's got about everything that's in the markets following us now. And a lot of people are like that. They start off slow and gradually push up the allocation as they gain confidence.
Well, there's so many out there now offering similar services, and most of them, quite frankly, scare the hell out of me. I mean, they really do.
Well, most services, because that was my background, was actually. I've been doing this since 2008, and so I've represented just about everybody out there. And I have to say, I haven't seen anything even remotely close to what we're doing here. Not even, an inkling close. They're all trying to get big returns with risky strategies. And, they're doing it in a number of ways that involve buying risky assets. No matter how you slice the potato, they're buying small cap something or another, and then either trying to get dividends or sell risky covered calls, and they're trying to hit 3-5% a month. Well, guess what? That is extremely risky.
Well, it is. Yeah.
Make 3%, lose 15%. That's what that is.
Yeah, that doesn't make a hell of a lot of sense to me.
No.
But, and of course, a lot of these guys, they'll always show you the good trades, but they never show you all the trades.
And that's what I'd like to point out, too. We have every trade alert recorded, public record, on the web for free, no password protection. And, you know, because I do the trade at the same time, repetitively, it's easy to go back, check these prices. And we're not trading junk, we're trading the top shelf, best products in the world. Not by my judgment, by the market's judgment. That's where the market has piled up their money. So.
Yeah, that's probably true. Yeah. Well, like I say, I'm gonna make myself some notes and then I'll give you guys all. Now, should I just talk to Dean? Is that who I need to talk to?
Yeah, call Dean, 505-322-7515. I do personal calls once people become a member. Had to stop doing freebie calls just because we get a little popular, and I do provide a lot of opportunity to talk with me direct. So Wednesdays is our paid member webinar. Yesterday we went for 2 hours. In fact, you saw some of our fine gentlemen who are very loyal join the webinar today. Just stop in and say thanks for the webinar yesterday and that they had to get out. They know full well that this is more of a promotional webinar, but they still stop in and say hi. But yeah, the webinar yesterday is where we can really talk in great detail about strategy, forecasts, how we're going to alter the trade alerts, really hone in on what the risks are. You know, kind of think of me as that earthquake predictor. I'm out there trying to find the problem. I'm not out there trying to find you the money maker. We already know what the money maker is. Just follow the big money. You know, that's where the safe return is. But what I'm really doing for you is trying to prevent loss and find the problems in the market and protect us against those problems. And so, you know, if nothing else, that's one huge value our members get from this service.
Right. Well, let me ask you a question while I got you on, and I'll let you take care of some other people. You made a statement a while ago, a guy kind of has a joke about trying to figure out what strike that you're going to do on the spine. I mean, is this something that you teach, or is this just you do it and then you put it out and say, okay, guys, here's the trade tonight?
So wait, can you repeat the question? Sorry.
Yeah. Okay. Say you on Friday at noon, you come out with a SPY trade. Whatever it is. I mean,
Sure.
Is this just something that you come out with, or is this something that you teach us how to come up with the same information?
Yeah, so we have two services, but I can tell you, this is our portfolio for the next 24 months. So the markets just don't move that quickly and things happen that fast. So very big picture, long term, looking far into the future. That's how our strategies develop. So we know if we get the big picture right and we hold to the strategy, we're going to have a high probability of winning with very little downside risk. So this is our setup for the next 12 to 24 months. I'd be shocked if that changed. Now, could I possibly throw out an inverted option caller on any of these assets because I think there's a pullback? Sure. But I'm not going to change what's in our portfolio. Not until we get a major change in conditions. And so I would argue the next big change in condition won't happen until inflation rates reported by the government start to perk up. Not real inflation, because we know they're trying to hide that as best they can. But until we got the central bank telling us, okay, we're either everything's great, we got a trade deal, hunky-dory, time to raise rates. We got to have ammunition to fight the next recession. We got to raise rates. That's when we would change our position stance. Or say the opposite happens. China, US go full at it. That's what might happen.
Yeah, very possible.
And if they go to war, what do governments do during wartime? Print a shitload of money.
Right.
So no matter how you, no matter how you slice the bread here, we're most likely going to have a period of inflation as soon as this money escapes from all these bubbles it's stuck in. Where's it stuck? Everywhere. It's stuck in real estate. Think about the general rise of populism around the world. We've had riots in Hong Kong, Lebanon, France, Italy, murders at high rates all over the US. What's the big problem? I'll tell you what the big problem is. Medical and real estate have skyrocketed in price, and earning and wages have gone flat. So everybody's pissed off because they can't afford their lifestyle.
Right.
So that's the big picture. Inflation is happening. At some point, they're all going to team up and say, all right, guys, I'm going to tell all their banker buddies what's going to happen. Banks always make money no matter what. We know that. They either get bailed out to make money or they get insider info. But eventually they're going to rise those rates. And that's when we would start to significantly change our outlook. But you can see even when that first starts happening, the only change is going from emerging markets to silver. But it'll be during this period where we got to call the top and get the hell out of gold and silver, because we're going to be coming towards the end of the funny money period.
Right.
Okay, so most likely, we're running out of steam. 2 years max, I'm predicting, before we start to see rising rates from one reason or another. And here's my basis to support that. We're at the federal fund rate 1.75 to 2 range. So if they try to slow this as much as they possibly can, which I think they will, depending on how much stress Trump puts on them, they'll expedite it if they have to. But if we have this kind of casual dance with China where we're talking about farming products, we're going to delay the tariffs a little longer. As long as that's happening, I think they can delay this as long as possible. So just, we got potentially 7 rate cuts before we get to the 0 range. If they do 1 rate cut a quarter, it gives you about a little under 2 years before we get to the rock bottom rate. They can't go lower than that. It'd be absolute insanity if they went below 0.
Well, that's true. I kind of look at it as we're gonna probably skate through the election in 2020. 2021 is a flip of the coin.
Yeah, they're gonna have to raise the rates, I think, before 2021, 2022.
Yeah, I would agree
Without
with
some
that.
sort of productivity miracle. And just look at the general trend. They're trying to start a bottom-up liquidity strategy. We got a question. Dean says so. We got 2 products, Donald. One is to put the trade alert on a silver platter and give you a 30-minute video each day telling you why we're doing it. But we have a boot camp that is pretty neat. And it's not a technical, I'm not big on technical analysis. I'm not a big fan of iron condors or calendar spreads or butterflies or any of that nonsense. Whole lot of work for no benefit from my standpoint. So my boot camp's much more about trying to evaluate the risks, understand these key macro ingredients that really change the big picture in the markets. And so we do have a boot camp. It's an online boot camp. It's Tuesdays and Mondays. So Mondays just Q&A. Talk about whatever you want for up to 2 hours every Monday. Tuesday's the lecture. So what we were looking at today was part of the first lecture. After the lecture goes out, you get an email with all that stuff I was showing you, all the Twitter feeds, all the YouTube accounts, all that jazz.
Yeah.
And the quiz. And so we're going to try to keep you on your toes. It's more like, it's much more interactive than just a pure lecture. So this is our outline. and it repeats 3 times a year indefinitely. So what's interesting is, you know, we'll look at the big picture with current market conditions. This first webinar comes up actually in November, so coming up soon. But think about it, 4 months from today, we're gonna do the same module again. And then 4 months from there, we're gonna do it again. That'll be right in the heat of the election. So it'll be fun to see these same ideas illustrate different political and economic conditions.
Right.
Module 2, you know, I'm feeling you probably wouldn't need, but some people do. This is the idea of this is to, in 16 weeks, to make you an expert at every aspect of this product, to understand the option volatility, the different types of collar trades. You know, everybody can place the trades. You know, this is not rocket science. There's nothing risky about it. You know, we're buying puts, we're not selling puts. So if we ever get assigned, we're in cash. We're not going to wake up one day and we own some stock that we paid too much for because we got assigned on the put.
Yeah.
So it's everything about this super safe, super passive. It's designed to never touch the positions outside of our trading period. So the first module is the one you got a snippet of today. Big picture. I'll adapt that every 4 months to what's topical and happening right now. So we'll be able to look at how that changes over time. So it's a long-term thing. Even though we're going to teach everything you know in 16 weeks, hopefully there'll be certain modules you want to take over and over again because it will change as the conditions change. We spend 2 weeks on call options, 2 weeks on put options. Then we put it together and talk about the option collar, tight versus loose. A whole week just dedicated to that inverted or upside down collar, which I would argue is the only safe way to really short these assets with a consistent strategy. I like crypto, not a lot. We got 1% of our total portfolio in Bitcoin this year, and it's generated something like 250% return. But again, that's the same trade as the gold trade. So we'll be helping you get out of that.
Yeah.
Telling you how to get it safely, but that's a 1% position. That's optional. Then we got 3 weeks to show you how to do this. We actually spent over $50,000 building something like a Tesla Gigafactory, except for building these templates and these spreadsheets. So we will issue you your own copy. It's a Google Drive spreadsheet, so I can actually help you fill it out. Not everybody wants to do this, but a lot do. So we'll spend 3 weeks learning how to fill that spreadsheet out and actually input all your trades together. And then this is going to be week 13. It's all about this portfolio right here. So we'll be spending a good hour and a half just about this slide right here.
Okay.
Okay. Week 14, what do we do after a financial crisis? That'll be an hour and a half. You know, all the stuff we were looking at today was just big picture. We're going to zoom in on these different market conditions. So what do you do after a big crash, a reset? Bond markets reset, stock markets reset. All right, well, that's where this slide, an hour and a half specializing in that. Now, we may be quite a ways off from that, but it doesn't hurt to prepare ourselves. So we're going to learn some different ETFs that might make more sense in the beginning of a business cycle versus at the end of a business cycle, which is where we're currently at. The last 2 weeks, we'll do a little bit of extras. Our boot camp has a few additional carrots on the stick, you could say, to get people in there. Besides the education, it does have some exclusive trades. And so one is I'm dying to short the Chinese currency with the futures market. And we actually cover that. That might be the one thing that option traders would want to catch on the module 2, is I'll show you how to do the futures trade to short the Chinese currency. So that is potentially one of my highest conviction trades as soon as the trade talks break down and they threaten new tariffs. And because the Chinese have a very, very immediate reaction to these tweets. They immediately go devalue their currency to offset the tariffs. So that's a trade we've been excited to get into, but waiting on until the next opportunity comes. Also, anytime I would do a speculative spread trade or any put option writing, it would only be for our bootcamp folks, because you need to really know what you're doing if you're writing puts or doing spreads. Position size becomes so critical when you start using some of these more advanced strategies. So again, the bootcamp will have some exclusive trades in there that are not part of our normal advisory. Again, the advisory is designed to make your life easy, passive, and stress-free. So we never do anything speculative or risky in those portfolios. So those, you're going to be trading this setup right here most likely till 2021.
Okay. Yeah, and that's something simple, yet
You
still
know, it
makes.
looks simple. You got to realize this is more advanced than anything you could build on your own. No way you could build this on your own. 15 companies,
I
right?
agree.
That automatically rebalance every day for free. You're collecting dividends now from 1,500 companies instead of just from, you know, whatever handful of random guys you ended up with. But what's more important is you're doing it from the biggest companies in the world, not the smallest.
Yeah. Okay, well, let me, like I say, let me make myself some notes, and I'll give you guys a call and we'll go further.
Excellent. Well, hey, I really appreciate you interacting with us today, and certainly would love to get you in the program and into, you know, out of the freebie webinar and joining our normal crew who is in the Wednesday webinar.
Okay, and I appreciate your time and information.
Well, thanks, sir. Appreciate you.
Yeah,
Thank
Donald,
you.
look forward to
later.
working with you, bud.
Okay.
Just give me a call when you have a moment, okay?
Okay, thanks.
Okay, thank you. Lewis, did you have any more questions for us, bud? Now that you,
I'm fine. I'm right here. I'm here. I'm following you, trying to.
okay, great. And just call me if you do have any questions, okay, bud?
Thank you.
Thank you, Lewis. Look forward to helping you, bud.
Let's see, Joel, you should be unmuted now if you wanted to unmute your mic and ask any questions. I think you have your mic muted if you did want to ask any questions there, Joel.
Yeah, and Joel, thanks for coming in. I actually haven't seen your name yet, so appreciate you taking the time to join us today. Okay. If you don't have any questions, Joel, just call me if you do come up with something, okay? My number is 505-322-7515.
All right, guys. Well, that is a wrap for today's presentation. I really appreciate everybody's time. Hope you found it valuable. And tomorrow we'll close out our SPY trade and open up another one. Oh, we got a live chat. Let's see what the chat message was.
It was Joel saying he didn't really have any questions, and Ron said, thank you.
Okay, great.
Thank you for coming in, Ron. Appreciate you, bud.
All right, guys. Thank you so much. This replay will go out Saturday.